What if your six-figure income, great credit score, and assets are not enough to get your mortgage approved? On this episode, we are going to talk about how you can see underwriting from a whole different lens and how beneficial it's going to be for you when you are trying to get a mortgage for your next house. Thank you for joining Wealth, Legacy, and Property. On this episode, we talk about how to leverage real estate to build wealth and also leave a lasting legacy. On today's episode, my favorite mortgage officer is back. Not only him, we also have another special guest with us, Kim Martin. She is a writer. She's coming to tell us more about underwriting, give us more insight into that space. As we all know, Rich is our favorite mortgage person, so he doesn't need any introduction. Thank you, Kim and Rich. And Kim, if you can tell us a little bit about yourself, we'll really appreciate it.
You bet. I've been in mortgage for quite a while as my oldest daughter, which is 30 years, underwriting for most of that time. And I've been with Cross Country for 7 years, and really just a lot of mortgage banking and risk assessment is my background.
Great. Thank you for joining today, and excuse the background for today. We also have a special guest with us. So let's start. As Rich, you might know, I cater to a wide spectrum of clients, right? Now, underwriting, like I stated in my intro, seems like a mystery to most home buyers, even including real estate agents and real estate investors. What I want to know is, why is it that someone with a high income doesn't necessarily high income and high credit score doesn't necessarily mean that they are going to get their loan approved?
There are a lot of different factors that go into underwriting, and especially with residential underwriting. Okay. As Rich has discussed before, there are different programs that have different guidelines that the borrowers have to fit into. But overall, the overarching reason or the overarching thing that everybody looks at is the ability to repay. So if a borrower has cash and they have reserves and they have great credit showing that they have the ability to repay, or that they have in the past, then that helps them in most likely their credit score and fitting all of those guidelines. What does impact it is stability of income, stability of employment, and then if there's additional loans or anything that happen to show up.
But the overarching requirement that you are going to look at, like you said, is going to be the ability to pay back the mortgage, right? So would you say that it's more of the numbers or the narrative, right? How I'm presenting myself or what the true numbers are?
I'll answer from an underwriting perspective. I think that it both goes hand in hand, because the narrative is super important when you're talking to somebody who has had past credit history problems or past employment history problems and how they've overcome those and where we're at today. So underwriting is definitely looking at past, present, and what we expect to happen in the future. So the numbers game does come into play because they have to fit within those boxes that the agencies or the investors require.
That makes sense. And just a disclaimer, this is not anything to bash underwriters or loan officers. And by the way, as you know, Rich, I'm almost close to getting my license to as a mortgage originator. So I do understand. On this podcast, we also try to address some of the myths out there when it comes to mortgages or even real estate as a whole, right? It may seem as if the mortgage industry or even the system is stacked against retirees and even self-employed applicants. Can you help us in understanding why there might be such a myth or misunderstanding, especially going back to the three most important requirements that you just stated? Can you touch on that a little bit for us?
I think, and Rich, you interrupt me as you need to, but when we're talking about retirees, it's usually something that is a fixed income. It's not increasing, it's not decreasing. They may get Social Security bumps every year. Hopefully they do. But we're looking at a fixed income and making sure that we're not putting that borrower in a difficult position, because it's not at the time of their life that they're typically expanding, right?
Sure.
They're not growing, they're not getting more income. They may, but we need to evaluate that we're not putting them in a worse situation that they currently are in. For self-employment borrowers, that is a risk. We love self-employment borrowers. I love looking and evaluating at tax returns because it tells a huge story about the ability to repay, the capacity of the business, and also what are the earnings? What does it look like economically for that business? And if we see that there are some tidbits with self-employed income that we're looking at tax returns that may show a trend that is starting, a trend that has happened, something that we need to overcome, that's where we dig in. So it feels like it's against self-employed borrowers, but really it is where we're just getting the full story to make sure that that is stable and continuous income.
That makes sense. And Rich, do you have something to add to that?
I think twofold, really, with we're talking about, I think the question opened up that things seem to be stacked against the self-employed and the retired. Self-employed is an interesting dance because with the relationship they have with their accountants, they're trying to save money on taxes. And their accountant and them are doing what they can to minimize their tax burden. But at the same time, that has a lasting impact on what we're going to be able to do, because the money they show Uncle Sam is the money that we get to qualify them with. So that always makes a challenge. You started the podcast by saying, hey, I've got a guy that's making great money, but when their accountant's done with it, they're really making great money. So that's we're left, because of the way Fannie Mae and Freddie Mac and FHA look at it, we're left with the bottom line. There's a couple things we can add back in, but ultimately the bottom line is what's important. Now, the retirees, I think Kim made a great point about this. We don't want to set anybody up for failure. It's bad for them. It's bad for us. It's just bad for housing in general. So we want to make sure that they succeed. On the other side of that, we also have some retirees, while on a fixed income, they have some larger assets. And I think we have an ability to sometimes use some of those assets to add to some of the income that we have. And we've got some various ways to do that. So if we have somebody who's relatively flush and they've shown that they've saved money throughout their working years and they have big balances, we can bring some money in and help them out a little bit more. So
that makes sense. So I guess it goes back to addressing the numbers and also the narrative, right? Because we have to look beyond the numbers to fully understand that individual's financial profile, right? Because everybody, like you just stated, Rich, it could be on Social Security, but it could also have some assets that can actually help in getting the loan approved. You've touched on the three main requirements, right? Is there any other requirements that underwriters usually also look at that we probably haven't touched on yet?
Kim, do you want to cover the 3 C's? Because I think those are really the main ones.
Right.
Well, you could exactly going back to the history of probably when Rich and I started in mortgage, it was always about the credit, the capacity, and the collateral. So it's if your credit is good, your credit history is good, that shows you have past credit history. If you have capacity, that means that you have the ability to make that payment, right? That's what we call in the industry your debt to income ratio, to make sure that your ratios fit in within the tolerance of the guidelines. And then collateral, of course, the home. That's what our loan is based off of. So as long as the collateral meets the guidelines and is in good standing, minimum property standards are met for your either state or local requirements and or federal requirements. Those are the things that we base everything off of. Everything, as we've talked about before, on the narrative of the loan. It helps the underwriter really see the path that we need to go. And is this a great fit for the borrower? Are we doing the best loan that we can for this borrower? So I think that what really ties us up is we're looking at the whole picture. And what is funny is that you said underwriting seems to be a myth or seems to be a wizard behind the curtain. However, it's pretty basic. It's just making sure that that ability to repay is met.
All right. That makes a lot of sense. So rapid fire, I have 3 questions. What is the most overlooked item that derails a file?
So I think number one, currently, I won't even
Mhm.
talk about history, but what we're seeing currently is a trend is a lot of borrowers are buying on the Affirm, on the Klarna issues. They're using that as payment to buy items. And this is a major thing because we have to use that in their liabilities to qualify them for the loan. So they think that it's an easy, fast loan, but it is something that can impact their ability to repay and their debt to income ratios. So when we're looking at bank statements on a loan, we see those payments and we have to hit them for that. So
Right.
that's something that a lot of people don't really think about when they're getting a new loan, getting an additional loan while they're waiting or while they're in process for a home loan. And that impacts us greatly. And that's a trend that is on the rise.
And those loans from Affirm and Karma typically don't show up on credit. So you have to look as a loan officer, you have to look other places for them.
Right.
And it's not as easily seen. Kim won't want to hear this, but I can tell you the percentage of loan officers that actually go through line by line on people's bank statements is really small.
I would agree because we end up in underwriting at the end going, oh gosh, we need to figure this out. And so it happens. And it's something that the borrowers don't tell you up front, right?
I didn't know that, so that's great. Oh, that's scary. Last one. What compensating factor have saved a deal in your experience with all the people that you've worked with?
A compensating factor is definitely reserves. If a borrower has additional reserves in their account that they're not using for funds to close, that is high in even any agency's book as a compensating factor.
Okay.
What I like to look at myself is I look at a payment shock, which would be how much are you paying for your current housing versus how much is this proposed new mortgage payment going to be?
Okay.
And if you are substantially higher, how are we going to cover that? Because how's a borrower going to budget for that? Do they have those reserves? Are we putting them in a bad situation? Do they have that ability to repay it? And I think that that's the one thing that I look at for compensating factors. What we do ask, and what a lot of our loan officers are doing great things at, are asking those additional probing questions to give us, the underwriters, the decisioners, the complete narrative, the background of the borrower and the background of what we're trying to do and what we're trying to accomplish. And that helps us to really see that we're making those great decisions for the borrowers.
Sorry, Brian.
In our office too, it's mandatory, and for all the branches that we process for, that there's a cover letter in there so that the processor has some idea what that narrative is. Okay. A classic example I just talked to, there's a big misconception out there that you have to be working at a job for 2 years to get a mortgage. Now, that might be true depending on how that job pays you, or if you're self-employed. But at the same time, the client I talked to earlier today, she's about to get her doctorate in pharmacy, and her wages are going to double. And once she gets the doctorate, she's actually going to be able to go full time. Now, ultimately, she's going to be in a brand new job in August. But I have a transcript for the last 2 years that said she's been studying to get her doctorate in pharmacy. So that narrative, if you will, help explain why we don't have a 2-year record of full-time employment. But honestly, that's okay.
All right. That's great. Thank you so much. I've learned a lot on this episode, especially with that payment history that doesn't show on credit. So hopefully my audience or my listener is going to benefit from this discussion. We are going to move on to the next episode, but I want to thank Rich and Kim for blessing us with their presence today.